What up? Well, I'ma break it down one time. I'm the man and I'm letting y'all know. Yeah, we getting that guap, that fitted, them chips. Yeah, we stacking that dough. I said I'm a hustler, baby. You know I'm a hustler. You know I'm the man. I'm a hustler, baby. You know I'm a hustler. You know I'm the man. I'm the man. It's been part of the plan, I don't think you understand. I see him on the gram while they flexing rubber bands. I'm working on my foreign exchanges out in Japan. $250,000 out in Philly, 50 grand in Michigan. Appearance in Atlanta, that's another 20 bands. Bring it back to the crib and invested in my daughter. Yeah, she only 3 months, but we working on a brando. Y'all can keep the bando. I got a plan to put my baby in a Lambo and buy her properties in LA and Orlando and let her run the family business. When I'm 50, I might learn to play the banjo. Country boy with dope dreams. I'm trying to open up a clinic for the dope fiends and drop $1 million on the school and us some dope teams. You see, the money ain't the mission, but the mission is to make it make a difference. I'm the man. What up? Well, I'ma break it down one time. I'm the man and I'm letting y'all know. Yeah, we getting that guap, that fitted, them chips. Yeah, we stacking that dough. I said I'm a hustler, baby. You know I'm a hustler. You know I'm the man. I'm a hustler, baby. You know I'm a hustler. You know I'm the man. I'm the man. Look, I think they get it. I know I got some critics, but still I'm fully committed to building a legacy with my family. That's a great team. Great grands living up bread from 2018. Keep the circle small as you can, hard as it may seem. Put the vision down on the paper, no time to daydream. Put the plan out in the motion and make it mainstream. We gon' get you out of the struggle and help you make green. Straight king. Ain't got no problem with still whipping up some baked beans. And rocking chucks with a t-shirt and some straight jeans. And take the money that I would've wasted and go open restaurants in Beijing. Boy, we international. And tune them out when they start saying you irrational. You see, I'm really setting up for the give and go. And getting knowledge to my daughter, she gon' finish what I started. Like I told you, I'm the man. What up? Well, I'ma break it down one time. I'm the man and I'm letting y'all know. Yeah, we getting that guap, that fitted, them chips. Yeah, we stacking that dough. I said I'm a hustler, baby. You know I'm a hustler. You know I'm the man. I'm a hustler, baby. You know I'm a hustler. You know I'm the man. What up? Well, I'ma break it down one time. I'm the man and I'm letting y'all know. Yeah, we getting that guap, that fitted, them chips. Yeah, we stacking that dough. I said I'm a hustler, baby. You know I'm a hustler. You know I'm the man. I'm a hustler, baby. You know I'm a hustler. You know I'm the man.
Oh, brother, oh, brother, oh, brother.
Welcome back to a special installment of the Matt Core Show. If you haven't already, I don't know what you're doing with your life, but destroy the like button, destroy the subscribe button, and destroy your life nemesis. You might want to save that last one for a little bit later in the day, but in real time, hit the like and the subscribe button. Save the whole nemesis destruction for at least tonight. You know, get some dinner. You want to probably carb load. You don't know how much energy you're going to be burning on it. But I do appreciate you guys joining in. It's very, very kind of you. We are going to be getting the FOMC, the Federal Open Market Committee meeting results at 2 p.m. If you're watching this in real time, that's in about 11 minutes. So we're going to find out that they did not change the Fed fund rate. I'm statistically 99% confident that that's going to be the result because that's exactly what the bond/yield market is telling us. Do not be surprised when they don't change the Fed fund rate because right now, literally, the odds that they're not going to change it is 99%. What's going to have a huge influence on the market is what the SEP has to say, the Summary of Economic Projections. That's where all the voting members of the FOMC, there's 19 of them, decide what's going on in their mindset in the coming time of where's unemployment going, where's GDP going, where's the Fed fund rate going, where's inflation going. That's what's going to move the market. It's the dot plot. All the voting members get to drop a little dot on where they think things are going to go. So we're going to be able to compare that to the previous numbers of, are they a little bit more optimistic? Are they a little bit more pessimistic? Are they more hawkish? Are they more dovish? Are they more bullish? Are they more bearish? What's going on? That's the information. That all comes out at 2 p.m. Say it with me. That comes out at 2 p.m. That comes out at 2. Come on, guys. I can't hear you. I've bugged all of your apartments. I've bugged all of your houses. I've bugged all of your cars. I've bugged all of your places of work. Say it with me. It comes out at 2. No one's saying it. You guys are making my job a lot harder than it has to be. I don't know why you guys are making me struggling right now. But anyway, you might be thinking, wow, that's a lot. Whew. Good thing I ate a hearty breakfast this morning and I'm ready for it. And I'm here to tell you that it is actually going to get crazier, because at 2:30, that's when Jerome Powell, the chairman of the Fed, will make his public press conference. So he's going to be speaking, and that's going to cause the market to go even more wild. Now, that might be exciting for a lot of you, because in here, the market has not moved much today. We're watching paint dry, but you're going to see what's about to go down, because from 9:30 till 2, we've done a bunch of nada, a bunch of zilch, a bunch of goose egg. That's been the volatility of the day. But what's about to happen from 2 p.m. till when the world's largest casino closes at 4 p.m., volatility is going to expand like no other. So I get it. I'm right there with you. You might be thinking, man, today's so boring. I wish something was happening. Dude, like I said, I'm right there with you. But you're about to get your wish. You are very, very much about to get your wish. I myself, I haven't really been doing anything. I burned some Apex accounts, and I'm about to get some more Apex accounts, hopefully pass. And because of that, I need your help. I'm trying to pass the test on some of this SIM-funded stuff. So I have 3 SIM accounts, 50,000 each, and I need to make 3,000 in each of those. So I need to make $6K in total on $150,000 of SIM money to see if I could pass the test. And to do that, I've come up with the ingenious idea of degenerately betting full bet size in one direction right before it comes out. And a question for you is, I'm not asking you where the market's going today. I'm asking you where the market's going from 2 p.m. to 2:01. And that's a really different question. I see a lot of people that, hey, we're ripping today, we're exploding today, we're crashing today, we're plummeting today. Hey, I get it. That's not my question. My question for you is, where do you think the market goes from 2 to 2:01? I'm not asking from 2 till 4 p.m. I'm asking 60 seconds. Those 60 seconds of your life, the market's going up or down. I need you guys to put on your thinking caps, and I need you to really dial it in. To really, really, really dial it in on this. Bullish initially, dump, up. Straight down, bearish, up. You guys are all over the map on this one. W Trader had up with a lot of P's though, and I have to admit that's convincing. I haven't seen anyone else in chat use that many extra letters, which I can only assume means an extreme amount of confidence. Everyone else is just saying up or down, but W Trader, he said up with 18 extra P's at the end, so that's confidence. I'm not seeing, oh wow, Jose's coming in with a bunch of views. Oop. Do a poll. How about don't tell me what to do, Ghost? If that is your real name, Ghost X. I bet that's not even your real name. I bet it's not even your real name. So no, you can't tell me what to do. Halt to the downside? I don't think they're going to be halting the market. Rates are going down. Market will rocket. You think they're going to cut rates? You're high. That's not going to happen. That's not going to happen whatsoever. You think they're going to cut rates, slap a da base? I fully know that is not your real name, because that's a crazy name. They're not cutting rates, folks. I don't want to be the bearer of bad news. They are not touching rates. They're not going to increase them. They're not going to cut them. They're not changing them. And you might be thinking, wow, that's really, really confident. Where are you coming up with that? Right here, folks. Back in 9th grade, I learned how to read, and I can read the fact that there's a 99% chance we're at 5.25. 99% chance we stay at 5.25. We're not changing. They're not cutting. They're not increasing. We're staying here. 99% chance. In fact, there's not even a real chance of a rate cut until mid-June. There's a 60% chance by the time we get to mid-June. They don't even think there's going to be a rate cut in May, dude. May. Like, let's just, hey, don't make fun of me. I couldn't read till the 9th grade. I was slow to develop. Jeez, why is everyone picking on me? Anyway, we're also going to be getting the SEP, the Summary of Economic Projections. This is the most recent one from December, so this is not today's, but I just want to clarify what it looks like. A bunch of nerdy numbers and whatnot, and you get the idea of like, oh, okay, they thought, like, you get the idea of where the average voting member, it's all these fancy little dot plots right here of like, all the members think this, but then in 2024, there's some disparity. In 2025, there's more disparity. In 2026, an even bigger disparity, blah, 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 blah. So all these dots represent one voting member, and then you kind of get the median vote, and you get all these metrics of where do they think GDP is going to go in 2024, 2025, 2026, longer run, blah, 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 blah. That's all going to be coming out as well. If you want to look at it yourself, go to federalreserve.gov/monetary policy, and it'll be right here, March. It's going to pop up right here. Like, I know nothing's there right now, but believe me, it's going to be popping up. And then you just click on it, and I mean, it's going to be over. It's going to look like this. It's going to say press conference, projection materials, and then you click on PDF, and it will pop up. This is the most recent one from December, and we're going to look at what did change, what didn't change, all that good jazz. While we're waiting for that to come out, we have 3 minutes. I do want to let you know some crazy stuff's going on in the world of crypto today. SEC waging campaign to classify Ethereum as a security. Just in, the SEC is waging an energetic legal campaign to classify Ethereum as a security. Now, I think that's interesting. I know we're all here thinking, man, that's an interesting legal campaign, but it's a bit lethargic. I wish we would have an energetic legal campaign. And boy, oh boy, do I have some news to report to you, because that's exactly what went down today. No more of those fucking lethargic legal campaigns. We finally got an energetic one. Huzzah! Energy. It's one of those. I don't know, but letting you know why ETH is not having the best day. On top of that, simultaneously, Ethereum Foundation is under investigation by a government authority. So the Ethereum Foundation is a nonprofit organization running Ethereum, and it's based out of Switzerland. And apparently there's a state authority looking into them. So double no bueno situation for ETH today, just so everyone knows what's going on. So just a very quick crypto update. A little bit later, people sent me some funny videos about AOC. I figured we could watch that in between the time of the announcement all the way up until Jerome Powell's press conference, because we're going to have an awkward like 15, 20 minute downtime, and I don't want people to feel weird. So I figured we could do something like that. But here's a 1 minute chart. The SPY is currently break even on the day. The Qs are break even on the day. Surprise, surprise, things are break even because the announcement is not out yet. It's just not out yet. We have exactly 2 minutes. Exactly 2 minutes till the market does its thing. And I need to get these three accounts passed right here. Apex account 70, 71, 72. Apex 70, 71, 72. Okay, they're all tethered together. And I might be able to make money if I do this right. God willing, I might be able to do this right. All right, maybe I should get some audio things set up. All right, let's get this. All right, they're talking.
That we liked in terms of the disinflationary trend.
All right, how much time do I have?
Things like year over year for a full 12
buddy.
months of core PCE.
Buddy, we're going for it.
So we're going to pay attention to
we're going
data
for
points
it
as well.
I've been so unlucky over the past 2 weeks of my life that I think all of my luck is converging on this moment.
Worry the Fed, and I guess
60 seconds.
Question would be,
they're talking. They're doing their thing.
Cut rates before, maybe even well before, inflation gets down to that 2% level.
Which way should I go? Bullish or bearish?
Discouraged by the inflation data over the last
Bullish or bearish?
But you know, in economics, things generally don't move in straight lines.
All right, they're
Some
talking.
bumps along the road
I need to get
expected.
ready.
I think the big picture
I need to
remains
get
unchanged.
ready.
The big picture, as was just mentioned, is inflation is a lot lower than it was a year ago. You know, our expectation,
nervous.
I think the Fed's
Bull?
expectation is that it will continue to move
Bull
lower
bear?
in the months
Puts,
and quarters.
calls, bull
You know,
bear?
that big picture, that's the foundation of rate cuts, and I
All
think
right.
that remains very much on
All
track.
right, we're doing it.
And as a consequence, you know, our expectation is that today the emphasis will be on that big picture and on the rate cuts still in the forecast, as again, you know, inflation is lower.
Let's
and
go.
That's the basis of the rate cuts.
10
Of course, though,
seconds.
things have been fairly bumpy when it comes to these economic
Order
data
submitted.
points, and we don't exactly know what the Fed
We
will
went
say
bullish.
in
Let's go.
the
Explode.
commentary, but that's going to be
Go.
very important
America.
as we listen to all of
Go.
this, and we think that
Charge.
there's just
Target
going to be
filled.
Order canceled. Go to Steve Leisman here as he
Boom.
gets ready for
3K,
us to tell us
3K,
exactly
3K.
what the Fed
I
is
am
going
the
to do.
best
Steve, what do you got?
trader ever. 9K. Easy peasy lemon squeezies. 3K, 3K, 3K. Shut up. Everyone shut up. Shut your dumb faces. Easy.
I'll get back to that in just
Easy.
a second. They see the economy expanding at a solid pace.
Losers. If you didn't take that
State
trade,
inflation has eased.
it was
It
obviously
remains elevated.
financial
Same as
advice.
the last
Easy
data.
peasy
There's
lemon
a theme developing.
squeezies.
Here it is. Not much change. Only one change.
Easy
actually,
peasy
about
lemon
job
squeezies,
gains
team.
remaining strong. No longer saying they
Ma,
moderated,
made it.
saying the risk between employment and
Easiest
inflation
trade
goals are
ever.
moving
Look at that. I could have
into
made
better
more. Dude, I
balance.
could
They
have
also said
tripled
they
those numbers
still do
up.
not expect
Could have
it will be
tripled them
appropriate to
numbers
cut the
up.
target rate until there's greater confidence.
Hey, if you want to
Inflation is
degenerately
approaching
trade with someone
2%,
else's money,
which is
it
to
is
say
pinned
they
to the
don't
top of
have that
chat. You can
confidence
check it
yet, so
out.
they're not
Apex
projecting
Trading
when those
Funding.
cut
If
rates
you
might be
want to
cut.
make
On the
9K easy
projection,
peasy lemon
prediction
squeezies, but you also have to have like my immense knowledge of the market. You could do it as well. Pinned to the top of chat. Check it out. I'm just calling it out because I'm going to exit out of this. Keep the money while I have it.
Down to 4%.
Yes.
This is the
Boom.
2024
Done.
year-end.
That's called discipline.
2 ticks higher on core PCE.
Boom. Done-ity,
to
done, done,
2.6%, and yet more growth. More
All right, what
inflation,
happened?
more
Wow, surprised they didn't change it.
left
Who
those three
would have
cuts
known
in
that?
place of 4.6%
Fed holds rate
for
steady, but
year-end.
indicates 3
They
cuts
did
coming
skew a little
sometime
bit more
this
hawkish. I'll get
year.
to that in a second. I will tell you
Exactly
they
what
cut
we
they cut
expected.
One rate cut away from next year. They went to 3.9 from to 2.39 from 3.6, and for 2026
All right.
to 3.1 and a tick higher.
Very
by the
quickly, shut up, Steve. Let's see what they changed here. Projection. This is the important thing. This is the SEP that just came out. Let's dive into it. Let's see what actually changed. So unchanged. December projection, they thought that GDP was going to be 1.4 for this year, for the calendar year of 2024. December projection right here, 1.4. They now increased that to 2.1. An increase in GDP, obviously bullish. Unemployment rate, they were expecting 4.1, lowering it slightly to 4. That's bullish. Okay, cool. PCE 2.4, 2.4. Core 2.4. They think actually core PCE inflation is going to go up from 2.4 to 2.6, the change from the December expectation till now. And then overall, the Fed funds rate, December projection 4.6, they're keeping it steady at 4.6, i.e. the idea for 3 different rate cuts. Because remember, we're at 5.25. This means 4.5. So you cut it to 5, you cut it to 4.75, you cut it to 4.5. So they are once again to the public saying, no, we're very confident of 3 rate cuts, and they're increasing the GDP and they are decreasing unemployment. This is bullish. That's bullish. The dot plots, a lot of members. We have some negative Nancy's up here, these high votes. We have a couple negative Nancy's. We have 5 to 5.2. Whoa. We have 2 voting members who actually think we're not changing the Fed fund rate at all. At all. Jesus. They think we're staying at 5.25. That's these 2 votes. So 2 negative Nancy's in the FOMC. 2 more who think we're only getting 1 rate cut this year. Then we have 1, 2, 3, 4, 5 people who think we're going to have only 2 rate cuts. And then most of them are coming in at 3 rate cuts. And then we have 1 person who's like, dude, I am dovish as all heck. And they think we're going to have 4 rate cuts. So that's this guy right here. So 2 negative Nancy's, 1 optimistic Oscar, and then, I don't know, we have a bunch of realistic Rogers as well. In 2025, one of these negative Nancy's actually thinks we're never getting cuts to the Fed fund rate. I don't know who this dot is, but that's one interesting vote. And then the optimistic Oscar, he's like, dude, we're really coming down. So big pessimistic Pete up here, and then an optimistic Oscar down here. And then I don't know what's going on with this pessimistic Pete, but they think we're just never cutting again. They think we are keeping rates high forever. I don't know what's going on there, but whoever this vote is, this vote, and I assume it's this guy. It's probably the guy on the right, not on the left. That's a joke. It's a poor joke, but it's a joke nonetheless. I have no idea which vote is which, but interesting. So overall, the SEP, you get this every other one, and by all quantitative, qualitative measures, this is actually pretty reasonably bullish. I mean, we're ripping now. We're ripping now, team. To all the people who told me this was going down, I bet you feel embarrassed right now. I bet. Where are you now? Where's all those tough talking negative Nancys in here now, huh? Where are you? Do you want me to scroll back in chat and find out who you are? Or do you just want to be honest and put your hand up right now? Because I'll do it. I'm petty enough. I will pause the show, scroll back up, and I will find all of you. I will find all of you negative Nancys in here, and I'll do it. I will call up Powell and I'll be like, hey, buddy, you're going to have to wait on it. You're going to have to wait on the whole public conference that's going to impact the entire global economy until I found out all the negative Nancys in here. The SPY just hit a new all-time high. A new all-time high. And we had people in here saying it was going to crater. Oh, you're so wrong. You're so wrong at this. You're so bad. You're so bad. You should feel embarrassed. Honestly, you should be crying right here. You should be your massive embarrassment. It's a huge embarrassment that you thought it was going to go down when we literally hit an all-time high. You need to ask yourself what you're doing with your life. You really do. You really do. All right, what are they talking about? How are they still talking? We already went over everything. Fed holds rate steady and maintains 3 cuts coming sometime this year. All right, we went over that.
And invest based on things like Kristen just mentioned, fundamentals, rather than trying to guess what the Fed's going to do.
Rick, I know you're with us. Tell us how the bond market is reacting and what you took away from what we've heard from Steve so far.
Why are they also...
Equity markets, they're happy as long as rate cuts aren't taken off the table. So they're happy.
Brother Rick.
Bond market saw 460 trade in twos, so it dropped a bit. It's back up to 462, down about 6 basis
Bitcoin's
points.
up too.
10s, they traded
bonds
down around
pop.
422. They're back up to around 4.25.
Dollars.
I do point out both those rates are definitely lower than they were just several days ago, but they're definitely
That's what the dollar's doing. It's on a roller coaster upside down going backwards. It's a real-time audio of the dollar.
I'm sure he'll get to in the press conference if you recall. It moved up to 3.9%, which
That's
means
the dollar.
3 months are 3.7, 3.7,
You can see it. You can practically
3.9
feel
happens
it.
to be a half a point above the low in January.
Let's get Rick up here.
23, which was 3.4%.
Give it to us, Rick.
Should we, the next jobs report, get an unemployment rate? And I'll guess what it is. My guess for the next unemployment rate is going to be 4.1%, because 4.1, 3.9, 3.7, the 3-month rolling average there is 3.9%. A 0.5% above the 3.4. It's the SAM rule. Boy, this has been brought up so many times over the last 36 hours, which basically states when the unemployment rate moves to a certain level, it seems to accelerate a bit. The Fed's going to be paying very close attention to that. But don't believe your lying eyes. Pretty much as Steve said, inflation's higher, growth's higher, and there's still pretty much 3 eases built in. All the markets are happy, but I'm telling you, as Sherlock Holmes fans used to say, the game's afoot. The Fed's really threading the needle on
the game's
guidance
afoot
and public opinion, but in the end, can they really cut rates when growth and inflation are still this sticky? I'm not sure I believe they can.
Steve, you want to react?
Yeah, I mean, what Rick just pointed to is something that I'm sort of gathering a question on, and I like the way Kelly put it. By the hair of our chinny chin chin, we escaped having that third cut go away. It is interesting here, higher growth, more inflation. I think when Powell is asked about this apparent inconsistency, the way he will respond is to say, well, we think we're tight enough here in order to handle some upside surprise or less of a decline in inflation and more growth than we previously thought. And it's a measure of how much restraint we think we're putting on the economy here that we believe we don't have to change our forecast, or the average official doesn't have to change their forecast. I think that's how he'll probably respond to that question. But I think it's coming out. I just want to remind folks, there's another shoe to drop here, an important shoe. We know the Federal Reserve began discussion, we were told anyway that they would, of the potential end to the reduction of the balance sheet. And so we're hoping to get some information, some details about.
Look at
when
them
the Fed
calls.
might bring
Look at them
quantitative
calls.
tightening to a close here, having brought the balance sheet down by $1.5 trillion, but still remaining. If it keeps going at this pace for another year, it would even stop at $2 trillion above where it started this whole thing back in 2020.
Very interesting stuff. And if I can go back to David Kelly, when we're talking about the balance sheet, we don't have the details. As Steve said, maybe we'll get some.
We're giving
here
it
in the
back?
press
What's going
conference.
on?
What feels appropriate to you, knowing what we do about where the Fed stands right now? What should the timeline look like, and what can the market take?
Well, I think what's really interesting is the Federal Reserve really doesn't know how far they can push down that balance sheet before they have a repeat of what happened back in September of 2019, where short rates suddenly bounced up. They're using this ample reserves regime. It's right now, it's abundant reserves. They've got all these reserves. So they're gradually draining reserves from the system, but they don't know how far they can
Whoa,
go.
Steve.
And they're
That
really
was a
making some
big
guesses
sigh,
here.
brother.
I've seen some research coming out of the St. Louis Fed saying that maybe if you get reserves down to between 10 and 12% of GDP, that might be right. But it seems to me very loose logic. But if they do that, yes, go ahead.
Maybe you can answer a question for me. If they have the standing repo facility, which is like
Steve,
something you can
chill, brother.
You know, break glass if in case of a fire here. In other words, if they don't have reserves, they can go to the Fed for those reserves. What's the difference? I'm trying to figure out a reason to be concerned the Fed could go too low on the balance sheet if this standing repo facility is something that really exists and will work. Why should I be concerned?
I agree with you. I don't think they should be so concerned, but I think they're worried that they will get blamed if they have a repeat of September 2019. There's no reason. They can mop up the mess very easily. I think that's exactly right. But what's interesting is if you use that measure, you're quite right. I mean, they were $4.1 trillion of a balance sheet before the pandemic. They could stop $2 trillion higher than that. But if they do that, and this is what's going to be interesting from the press conference, it's possible that Chairman Powell will indicate that they may begin tapering this year. And I think that would be a positive sign for the bond market.
Calls are being
purchased
purchased
again.
again.
A lot of support still at the long end of the bond market from the
Here's
Federal
what's going
Reserve.
on in the options
Why don't
market.
you react to the thoughts about the balance sheet and where the equilibrium value might be, and how far away are we from it?
I absolutely agree with all the comments that have been made. If you look at where we were pre-pandemic, there's still a lot of room to go. We're at like $7.5 trillion right now, but I think that the market will actually react quite favorably to this. If we get commentary from Chair Powell, just the fact that there is a discussion around quantitative tightening and when
I have
we
that
will
top.
see either the slowing
In
of
case
that or the
anyone was
ending
wondering,
of
I
that.
also have that
Remember,
top.
that's adding liquidity into the system. So I think a lot of the things that we're receiving, whether it's the 3 cuts that are still priced in, a discussion around quantitative tightening. And I go back to what I said earlier in terms of the data points that he's paying attention to, because Chair Powell has shared in whether it was congressional testimony, some of the other conferences, he has shared the fact that he is anticipating rate cuts this year, that we don't have to break employment to actually get our first rate cut. And just to put all of this into perspective, we're talking about 3 rate cuts of 25 basis points. Those 25 basis point cuts are far from accommodative.
I want to interview
we
the
also just need
negative
to put it
Nancy, who's
into
like,
the
dude, we
larger
are
context
never
as
going
well.
to change this.
John Bellows, a final thought.
You know, David highlighted the risk with regards to reserves. I think the other side of this is the point that was made, is they bought a lot of bonds in 2020 and 2021. You know, they expanded the balance sheet tremendously. And I think that's going to mean that their bias is going to be to continue the QT for a while and try and get that back down. Again, they bought a lot of bonds. There's a long ways to go to kind of undo that. And so I wouldn't be holding my breath for them to start buying bonds again.
They'll use liquidity as an excuse to stop.
Potentially.
Steve,
Rick,
you go ahead.
What's the bond market want to hear from Powell when it comes to QT? Obviously, they want to know that there's a whole bowl of lollipops that are out there, which is,
Well,
you know,
10-year
we're
note
going to
yields are already thinking about this.
Okay, go ahead. Tell me what they're thinking, Rick.
They're moving higher, and here's what they're thinking.
Yeah, they are, Rick.
Quantitative tightening
Dude.
is going to stop
Best to ever do
shy
it.
of any number. We're currently at what? 7.58 trillion. Last time we got as high as credit crisis, 4.5 trillion. We came down to 3.75 trillion. So the spread of where we're going to stop is going to be wide, and it's going to stop because of the notion that the reverse repo parking lot's getting empty And the bond market doesn't like if the balance sheet is much higher, in my opinion, than 6 or 6.5 trillion, which in and of itself, as you pointed out, is still 2 trillion higher than when they stopped after the credit crisis. And you know they want to use that balance sheet again should any type of crisis develop in the future. And we all know the crisis calendar seems to have a higher frequency than it used to.
How did I know that Rick would have an opinion on the balance sheet, guys? How did I divine that?
Familiarity, history, a long and glorious history. Thanks, guys and ladies.
Thanks.
Appreciate it. All right, coming up, we'll get more reaction to the Fed's decision. And we're just minutes away, of course, from Jerome Powell's press conference. We'll take you there live when it begins at 1:30. But first, a quick break. Stick with us.
All right. The TLDR is bullish, followed by more bullish. Big pop to the upside, tagged a new all-time high, coming down a little bit from there, but the SPY is now up 0.2%. The Qs are up 0.4%. Gold is up. Did gold hit a new all-time high? No, but it's looking good. Bitcoin's even up. Everything's popping. Will it hold? I don't know. Your guess is as good as mine. We have to wait for Jerome Powell to speak. Jerome Powell is coming on. I have it already. Their website. Jerome Powell speaking in 15 minutes. 15 minutes. We know what the guy in charge of the money printer, what his thoughts are, what he's saying, but I have a feeling that he's just going to keep slinging this thing to the upside. By all quantitative, qualitative measures, the SEP, the Summary of Economic Projections, is pretty good. I can't say by all. That's kind of a farce because they do think core PCE inflation is going to go up. In December, their expectation, the median expectation was 2.4%. Now they think it's going to be 2.6%. So that's not so good. But all the other numbers were pretty good. They think unemployment's going down. They think GDP is going to go up. So I can't say it was perfectly bullish, but it definitely favored the bulls. That's exactly why the SPY ripped from, what was it, 515 to 518, ripped $3 like it was nothing. So we're going to, we'll take the win. The bull camp will take the win. Hey, a new high is a new high. The Qs did not hit a new all-time high just because we were a bit farther away to start off the day, but looking good. I mean, the all-time high was 448.64. We ended up hitting 441.86. I just want to clarify that we are not out of the woods. As much as I'm stoked that I made $9K to pass those 3 Apex accounts, which that's pinned to the top of chat if you want to try that yourself. Each test right now only costs $30. So I think I spent $120 to pass all 3 of those tests. And I could, obviously the upside is extreme. But anywho, I want to clarify that for the remainder of the day, just because we initially popped bullish does not mean that the rest of the day is going to be bullish. If you look at the last 10 FOMC days, the movement from 2 to 2:30, 50% of the time is completely undone. We are not out of the woods. Half the time, whatever that move is, it becomes more extreme and we keep going that way. And then the other half of the time, it is completely undone. So just because we move this does not mean you should be married to the bull camp for the remainder of the day. It does not mean you should be married to your bullish position for the end of the day. And the exact odds on it are literally 50-50. 50-50. I'm telling you right now, if you are looking at this and you're like, you know what? I'm bullish for the rest of the day. Based on historic data, you literally have a 50-50 shot. 50-50 shot. And if you're okay with playing 50-50 shots, okay, have at it. I hope you crush it. I just want you guys to know that sometimes Jerome Powell pushes things even higher, or I should say in favor of the initial response, and then other times he completely undoes it. So I just want you to know. Now, we do have a bit of time to burn, so I want to watch this because people sent it in and they said it was absolutely hilarious. I guess AOC had a meltdown today at the hearing that's going on. So let's just give this a quick little listen to burn 5 minutes and then we'll go back to the market.
Mr. Bobulinski, I heard your opening statement. It's submitted to the record, part of our proceedings. I have a quick question. Simple. Is it your testimony today that you personally witnessed President Joe Biden commit a crime?
I believe the fact that he was sitting with me while I was putting together a business
Did you
deal,
witness the president commit a crime? Is it your testimony today?
Yes.
And what crime do you have you witnessed?
How much time do I have to go through it?
It is simple. You name the crime. Did you watch him steal something?
Corruption statutes, RICO and conspiracy.
What is it? What is the crime, sir? Specifically.
You asked me to answer the question. I answered the question.
No.
RICO, you're obviously not familiar with. Corruption
Excuse me,
statutes,
sir. Excuse me,
FARA.
sir. Excuse me, sir. RICO is not a crime.
Rico's
it is
a guy.
Category.
I met him at the
What
bar
is
the other day.
Category of crimes that you're then charged
You
under
have charges.
A long 100
You
list
have
of
charges. Sir, please
Want me to name the exact statute under RICO?
Yes.
Well, it's funny. In this committee room, everyone's not here. There's over 18
All right, sir. I reclaim my time.
lawyers that
I
went to
reclaim
law
my
school.
time.
I'll leave it up to you guys
okay,
to
thank
define
you,
the
sir. I
statute
reclaim my
under
time.
RICO.
Clearly, what we are seeing here today
Reclaim the time.
is a continuation of the 15-month saga of the Republican majority lost in the desert. Impeachment.
Is she saying that they're
101.
Jewish?
The
That's a little
majority
racist
party,
if you ask
or
me.
Whomever is raising impeachment must accuse the president of a high crime, a specific high crime or misdemeanor. I would like to submit to the record HRES 918, the House resolution to open this impeachment inquiry.
Without objection to order.
This resolution does not outline a high crime or misdemeanor. It's not here. Now, when we compare the
Jewish
chairman's
space
opening,
lasers.
from his previous opening, he's talking about Ukraine and Burisma and all of this. This entire inquiry is based on a blockbuster piece of information that was in a classified
R.I.P. Blockbuster.
room. And inside that room was a document alleging President Biden directly of a $10 million bribery scheme, a $10 million bribery scheme, extremely serious. What happened? What happened a month ago, Mr. Chairman? That document, the FBI arrested the person who offered those allegations for falsifying his testimony to the FBI.
So
this
much
entire
anger.
impeachment inquiry is based on an actual, provable individual who has lied. Now, responsible leadership would withdraw an inquiry based on
Just
that.
jacked up.
Withdraw it. Instead, what we are seeing is that this committee was warned about the falsehoods of these allegations long before that, warned by Trump's Secretary of State Mike Pompeo, and yet they proceeded anyway. The chairman proceeded anyway. This committee was warned by Rudy Giuliani associate right here, Lev Parnas, after that document about the falsehoods of this. Then held hearings where your own expert witnesses said that there was no grounds for it.
Dude, this guy is going to catch some shrapnel. This guy, I hope he has like a Kevlar sleeve on because he's about to get an amputation. These fingers are flying like no other. This guy, Mr. Phil, how do you pronounce that? Oh, can you guys not even see it? Is my head blocking it? Can you guys? Oh, you guys can't see his name tag. Hang on. I'll fix it. What is this name? How do you pronounce that? What, are we allowed to have? That's not a name. Now, I know I'm just kind of going off the rails on this one, but what is that name? Mr. Miffu? Is it French? Muffin? Mr. Perfume. Maffu? MFU me? I don't think this is a name. But anyway, this guy's shoulder. How is it survive? Like, it's going to get chopped off. These hands are flying like no other.
Impeachment.
Dude, you see how close that guy?
By Rudy
Watch this
Giuliani
one.
associate right here, Lev
Ready?
Parnas.
Get ready. Get ready.
After that document,
He almost caught
the
one.
falsehoods of this. Then held hearings where your own expert witnesses said that there was no ground for impeachment, and you proceeded anyway. And finally, as if none of this was enough, the FBI arrested the individual who was the source of the entire, to quote the chairman, heart of the matter, to launch this impeachment inquiry, and proceeded anyway. At this point, the story is not the fact that the basis of this impeachment inquiry is wrong. The story is why it's proceeding anyway. Why is this committee proceeding based on false charges? And by the way, no charges. I have yet to hear in the chairman's opening the allegation that they are specifically charging the president of the United States with. I'm hearing about Biden family. I'm hearing about this and that. I am not hearing the specific allegation by this committee. What is it? It's not clear. And
give me
that is
the pasta.
problem.
Where's the sauce?
The story
Where's
is
your
when
where's your
this committee
sauce?
knew that they were working with falsified
I
evidence.
need the
That's the
rigatoni.
story. And with that, I yield back.
Gentlelady yields back.
How much money would you pay if, when it went back to the guy being, I don't know, verbally accosted, what if he said, calm down? Imagine what would be happening in the world right now if he came back and that guy just went into his mic and he's like, calm down. Do you think it would have lit Capitol Hill on fire if that happened? If he just had the balls to just be like, dude, calm down. You'd pay $2 to see that? I'd pay $2. I think that'd be a good one. There's nothing more hilarious than seeing any politician get so worked up because they don't realize that the average person hates the average politician. I mean, the political class folks, they're not on our side. Like, I don't want to crack anyone's egg here. I don't know if that's a saying. If it isn't, it should be. That's a good saying. I don't want to crack anyone's egg here. But they hate us. Left, right, in the middle. It doesn't matter. They hate you. And all of that is for show. They don't actually feel like that. They do if they think their own power or money's at risk, but they're not arguing it for the well-being of you, for the well-being of their constituents, for the well-being of the nation. They're not arguing it for that. They're there just because they need social media clips and just, I guess, some hand exercises, some hand movement. But for whoever sent that in, much appreciated. That was actually pretty funny. But how do you pronounce that guy's name? Like, very seriously, MFUME. Is there a silent letter in there? Was it a typo? What's going on? What's going on? Was that a typo? What do we have happening? Oh, I didn't realize we are flying through today's show. All right, let's get this. We got to get the stream ready. Don't want to get DMCA'd. That elevator music. The big elevator business always comes after me whenever I play their stuff. They're like, hey, that's just for waiting awkwardly 11 floors on our main business. All right, let me add this. Nope, don't need that. All right, let's get Big Daddy Powell up there. Let's get Big Daddy Powell. Window capture. Add source. New. Options trading on public. FOMC meeting. All right, let's edit this up so we can see what he says, how he says it, and what impact it's going to have on the market. All right, should be starting momentarily. All right, the guy in charge of the money printer, the unelected dude who controls a vast amount of our lives. All right, let's do the old 3-minute. All right, so we have the dollar up top. We have old bitty Bitcoin on the bottom right. Let me do this one. Let's do this one. How's that look? All right, somewhat decent. We have the Qs in the bottom left, and we have the overall market in the top right. Things are good right now. The market did hit a new all-time high. The Qs didn't, but they're looking pretty strong. Bitcoin trading at 64.5 thousand. The dollar coming down, bonds going up. So dollar down, bonds up, overall market up, crypto up. That's been the initial reaction. But like I said, let's just wait. Calm, cool, collected. We have a minute until Jerome Powell starts speaking. I will unmute the audio when he actually gets up there. He'll be right above my head. And Godspeed. All I can say is Godspeed and hold on to your butts because this one's going to get a little bit wild. Make sure your butts are strapped in. Matt, didn't watch for a while. Are people still thinking AMC will have a comeback? Yeah, really stupid people think that. But no person that has even an average level of intellect thinks it's coming back. To directly answer that question. All right, pal, let's get going. Some of us have things to get to today. Some of us have things to get to. Is he going? Are we going? Let's do this thing. Let's do this thing. And we're off. Come on. Take the stage. Do your thing. Do your worst. Dollar top right, Bitcoin bottom right, bottom left is the NASDAQ, top left is the S&P 500. And right above my head will be Jerome Powell whenever he takes the stage. Everything on my watch list is green except for SMCI, which is a somewhat popular semiconductor play that recently decided to do a 2 million share dilution. So, of course, the price is going down. Other than that, everything is up, and away. Up, and away. Let's see how this goes. Well, while we're awkwardly waiting for him, check out Apex. If you want to trade degenerately the way I did right before that news, I did it all through Apex. Pinned to the top of chat in the description of the video. Use the code GOONY to get 80% off.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core
dipping
PCE
a little
prices
bit.
rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025.
Dollar taking a hit. This should put the
at the end
market
of
up.
2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy
Dollar's
will adjust
getting
as
crushed.
appropriate to
That should be
foster
good
our
for
maximum
Bitcoin.
employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves.
Dollar's about to
We remain
crack.
committed to bringing
Top right
inflation
of your
back
screen.
down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
All right. Let's hit him with them questions.
Microphone, right. Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation
10-year
down.
yield popping,
And, so
10-year notes going down.
When you just to follow up, when you
10-year
say that
popping,
you're willing to
4.3.
either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to
2
2% over
still
time.
higher, but
that is our goal, and we will achieve that
4.6
goal.
for the
Markets
2-year
believe
yield.
We will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so
bonds
we're
are
making
drunk.
projections that do show that happening, and we're committed to that
20-year
outcome. We will
bond
worry
ripped,
about.
dropped, and now bouncing, just drunk.
Hi, Chair Powell, Rachel Siegel from
Dollars
Washington Post.
on
Thanks
tilt.
for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing, services, inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Okay. And will you be able to get overall
Dollar
inflation down to
puking.
target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this
Gold's
year?
popping now
We will
too.
get aggregate inflation down to 2% over time. We will. And I would assume that what we'll
Microsoft's
continue to
looking
see
good.
is
Nvidia's
we'll see
looking
goods
good.
prices
SNCI,
coming into a new
Tesla.
equilibrium where they're
Meta's
going down perhaps
Meta's
not as
above
quickly as they
500.
had been earlier this year, where housing services inflation will come
Even rum's
back
taking
down
off now.
as current market rents are
Hoo-wee.
suggesting will happen. And where non-housing
Just hit
services
another
will
new
move back
all-time
down. Some
high.
combination of
You
those
just
things, and
witnessed
it may be
history.
different from
New
the
all-time
combination we
high.
had before the pandemic will be achieved and will bring inflation back down to 2% sustainably.
Another high. Another one. Another
The
one.
Wall Street Journal. Chair Powell, during your congressional
Timorous,
testimony this
The
month,
Wall
you
Street
said
Journal.
that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you
First cut's the
reconcile these
deepest.
views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment and, people's working lives. And so, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers
check
were quite
yourself
high.
on that, buddy.
There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need? Or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
Spies chugging along there, team.
Is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period if you look back. Unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Whoa, buddy.
Chris.
Hi, Chris Rieger, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question? I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing.
We are off to the races, boys.
But I don't think we know. I mean, my instinct would be that rates will not go back down to the very low levels that we saw where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or the last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Ann that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate. Things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can...
Bitcoin's taken off.
Many people did...
Up $3,000.
See the possibility of seasonal adjustment problems there. But again, you don't want to... You got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? You know, we tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and you know, feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the
new all-time high just hit on the SPY.
Really
Bitcoin ripping, dollar vomiting. Congrats to all the bulls.
Inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now, and we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, you know, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Go to Edward. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, well, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect you know, in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, you know, our mandate is for maximum employment and price stability and the other things that we do, and that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire. Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, Would you want to see unanimity on the
Should we
committee,
allow British
or
people to
something
ask
close to it,
questions?
meaning no more than one dissent?
Feel free to
before
discuss.
you begin cutting rates. Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity.
No.
People
Most
do
of you are
dissent.
saying no.
It's something that happens.
No.
Life goes
No.
on, and it's not a problem. We've always had
Absolutely
dissents.
not.
And so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you
No.
really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
Simon, one will be okay.
Simon Urbanovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing, essentially, and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress. And that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, you know, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's, you know, not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Victoria.
Hi, Victoria Guida with Politico. Also on the balance sheet, you know, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
You know, we'll be watching carefully, but one of the reasons we're slowing down, we will soon enough.
New all-time high on the
fairly
SPY.
soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserves situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates, those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, you know, drops near at zero?
Well, I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Go to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. Will you said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up
another new all-time
the process
high
for deciding that
on the
sooner,
S&P 500?
or will you wait until we're close to the end?
So it's sort of ironic that by going slower you can get farther, but that's the idea. The idea is that
that's not irony.
With a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these, what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point, ultimately, where you stop allowing the balance sheet to run off, and you But then, from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand. And then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above, above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Well, are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. But we would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Let's go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff.
Here
We've been
comes
hearing
some
a
crypto
lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of a CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not
Bitcoin going.
Getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress, signed by the president, to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. You know, it has applications in wholesale finance, in the payment system. And so to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. You know, I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Mark.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think, I mean, this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that, so Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8, so now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. I mean, there's a long list of things that we've done. I think I mean, nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not?
We're about to pop
What
again
are we
here.
to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times, so those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year, and what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE, coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data the data come in. We would, of course, love to get great inflation data. We got really good inflation data on in the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy, and now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Certainly welcome it. Okie dokies, artichokies. Here's what you need to know. Here's what you need to know. We just got the FOMC decision. Surprise, surprise, rates remained unchanged as there was a 99% probability of that happening. So the 1% offshoot did not occur. On that announcement, we also received the SEP, the Summary of Economic Projections, which was pretty bullish. It wasn't perfectly bullish. Yes, they are looking at the PCE core inflation to go up slightly, but GDP went up, unemployment went down, and they are pretty much sticking by what they said in this December meeting of we're looking at 3 rate cuts this calendar year. On that news, the market ripped to a new all-time high. As I'm kind of giving you the conclusion right now, the SPY hit another new all-time high. Bitcoin bouncing in excess of $3,000, the dollar dying, the NASDAQ up. Things are looking good. The market rightfully interpreted this to be a pretty bullish development, and here's to hoping that we can go even higher. Now, if you guys degenerately played calls or did something silly on the futures market like I did, massive congrats to you. And if you were negative Nancy playing puts, I kind of feel bad for you because you got absolutely steamrolled today. But that's the very quick TLDR of what in the world just happened. Obviously, tomorrow we're going to be streaming this again. Don't forget, hit the like. Don't forget to hit the subscribe. We'll be streaming once again tomorrow morning, 9 a.m. bright and early. I hope to catch you there. I hope you made a buttload of money today, and I hope you're going to make another buttload of money tomorrow. That's what I have for you right now. I'll catch you on the flippity flip. Have a good one. Peace out.